Good morning, everybody. Welcome to this Gravita R&D Tax webinar. I'm Tim Palmer. I lecture around the UK, and I'm also a tax consultant with Gravita, Chartered Accountants in London. I'm simply here today, really, just to introduce this live 1 hour R&D webinar presented by Kate and Pieres. Obviously, Gravita does so many different things, but R&D is a big part of the things that our tax department do. And my experience in R&D is that I think it's quite a complex area. And in my experience, unfortunately, some companies and accountants miss out on R&D claims that they should have made. That's the experience that I've had. And also, when I've done work on it in the past, I've found that certain companies have made incorrect R&D claims. Well, Kate and Pieres are here, and they're experts in this area, and they will be able to help you with regard to R&D. And in particular, they're going to review the 2023 spring budget changes to R&D, and also changes before that, after that, in the autumn statement last year as well. It's going to be a very practical session, lasting just under an hour. We finish at 10 o'clock. And what they've said is that they've got so much to cover today that they're going to take questions by email. And if you email the questions in, Kate and Pieres will deal with them after the webinar. So email your questions because they've got so much to do, and they'll deal with the questions after the webinar. Right, I think that's all I've got to say. So without any further ado, over to you, Kate.
Great. Hi, everybody. Thanks, Tim, for the introduction. Welcome, everybody, this morning to our webinar in respect to the recent R&D changes. Just a point to note before we get into the detail of the webinar. We did run a webinar in November last year where we addressed R&D relevant to the technology industry. We also touched upon the recent climate in respect of R&D inquiries. So I just thought I'd mention that because we do have the webinar slides and a recording available. So those of you that would like to have that, please do let us know and we can get that emailed across to you. So in terms of just picking up from that, we're going to be obviously picking up from the last webinar, but really delving into more of the detail around all of the recent changes that have been brought in within the spring and autumn budgets, and also what the combined changes mean for R&D claims. It's probably fair to say that in the past year and a half, there's been quite significant changes to the R&D scheme, and it's the changes have probably been the most significant since the R&D, since its inception in 2000. That combined with the increase in HMRC inquiries has actually made the environment quite challenging for all those companies wishing to make claims, but also agents that are obviously supporting companies on making those claims. So key points to note, obviously I've already mentioned. So if we just get into a bit more detail around the changes, and I'm going to pass over to Pieres, who will be addressing some of the 2023 spring budget changes.
Perfect. Cheers, Kate. Morning, everyone. So yeah, just to touch on it higher level on this slide, obviously, we do have the webinar, as Kate mentioned, that did cover these topics that we done back in November, but we will sort of retouch on it here and obviously discuss the autumn to give you everyone a bit more of a comprehensive view of what the landscape looks like. But regarding the spring 2023 changes, obviously we had the rate changes that crept in. That was for expenditure that was incurred post April 23. I know with some of the clients now that we're working with who, you know, were up to date with their year end, they're already starting to be impacted by the rate changes. We'll delve into that in a bit more detail, but higher level, you know, as unfortunately some of the people start to experience, the SME rates have gone down. However, RDEC rates have increased. And as I'm saying, we'll touch on that in a bit more detail. Something else that a lot of clients are now experiencing, a lot of companies are now experiencing, is the additional information form that was, you know, originally scheduled to come in 1st of August, but was finally brought in on the 8th of August. And that is a compliance measure that standardizes the type of information that HMRC expect to see from companies who make claims. And then we've had two other areas of guidance changes that affects accounting periods starting on or after April 23. We've got the pre-notification, which is a concept of notifying HMRC in advance of submitting a claim. And again, we'll touch on that in a bit more detail because not all companies may be required to do that. And then a bit of good news, which is, some of the guidance around extending some of the definitions, in particular, the concept of pure mathematics. And also there's now been some clarity on, cloud computing costs and data sets and bits and pieces like that, which is a bit of good news that we'll delve into later on. And then finally, we've got for accounting periods starting on or after April 24. We're just going to touch on this very quickly here, simply because it was a change that was originally going to be announced for the spring 23, but was postponed, was a concept on overseas subcontracting and externally provided workers. There's going to be now some restrictions coming in, which we'll touch on further down, but it's going to be a particularly big one for any companies that claim R&D on a lot of non-UK based costs. Thank you.
Thanks, Piers. So just to delve into each area that Piers has just highlighted, so rate changes is probably unsurprising to those of us that have been, dealing with R&D claims for some while, that the rates were going to be changed. So it's clear to make the distinction about how these rates operate, because you'll see in some later slides, some of the changes are relevant for accounting periods. Some changes are dependent on actual date of expenditure incurred, and this is one of them. So the rates have changed, both for the SME scheme and the RDEC scheme, and this impacts expenditure incurred from April 23. So the SME rate has decreased. So that it's decreased from 130% to 86%, quite a significant decrease. Conversely, the good news is the RDEC rate has increased. So the RDEC rate has increased from 13% to 20%, and that increase in rate has actually been the largest increase in the rate since the RDEC scheme was introduced in 2013, when the rate first came in at 10%. The SME rate has been at 130% for a number of years. I think it was brought in I think the increased rate was April 15. So, that's quite a significant impact on companies that are making claims under the SME scheme. So in what does that mean in tax benefit for companies? So the tax benefit is reduced from 33% to just a little over 18%, quite a significant reduction. The RDEC rate, the benefit on claiming on the RDEC scheme has actually increased from 10.5% to 15%. So generally speaking, the SME scheme is obviously still the more lucrative scheme. The impacts and the changes to the rates, as I mentioned, wasn't at all unexpected by us. And it basically the reduction in the SME rate and increase in the RDEC rate, it bridges the gap between the two schemes. Just moving on, I just thought it would be useful to have a summary table for you all of those rates. So just to see, so it's quite clear what the old rates are, so what the pre-April 2023 rates were, and what the post-April 23 rates are. So how do you deal with that in practical terms? We've got a table, an example of a company with an accounting period of February. So if in this example, the February 23 period, all of the for a company that's within the SME scheme, all of its expenditure for February 23 would fall into the pre-April 23 period. So the full rate of it would be allowed to claim the full enhancement rate of 130% if it was in the SME scheme. For a company that has an accounting period that straddles, so part of the accounting period falls in the pre-April 23 period, 1 month that is, and there's 11 months of the accounting period that falls in the post-April 23 period. So how you would deal with that in practical terms is you would split the expenditure in accordance with the number of months that fall into the pre-23 period and the number of months that fall into the post-23 period. and then you would apply the relevant rates to that apportioned expenditure to give you your total enhanced expenditure. So that's just how where you have an accounting period that straddles the rate change. That's how that would work. Obviously, moving on to future accounting periods. So when you're looking at an accounting period that falls fully after the rate changes, then that company is going to be subjected to the new rate changes in the post April 23 column. So just moving on.
Yeah, so along with the rate changes, one of the other things that was announced at the time was this concept of having a high intensity threshold that is specifically for companies that are usually highly loss making and undertake a substantial amount of R&D as part of their business. One of the concerns that was raised is obviously, as you saw on the last slide, is the rate decreases for the SME scheme was quite substantial. And obviously a lot of companies, loss-making companies that spend a large portion of their time undertaking R&D, there was concerns about, their sustainability and how much more time and resource they can keep invested in R&D due to such a reduction. So this concept of a high intensity threshold was sort of brought in to sort of go, okay, we'll sort of meet you in the middle somewhere. We'll find a ground where, we'll give you a little bit of leeway, if you like. And how this looks in practical terms, certainly for the spring 23 changes at the time, is if a company can demonstrate that 40% of its total expenditure within the period relates to R&D, then it will be allowed for this high intensity threshold. For a bit of detail, we did get a bit of clarity of what total expenditure actually means. And what it actually means is obviously the company's expenses in its P&L adjusted for any S1308 deduction that usually relates to the balance sheet, particularly in the software and technology field, but certainly others as well. Some development costs actually get capitalized to the balance sheet. So unfortunately, that has been captured as part of this calculation, which is obviously we need to consider that as well. So you've got your P&L adjusted for any S1308 expenditure and also adjusted for any CT amounts as well, so the amounts allowable for tax as well. So that's sort of the rough calculation that was adopted. So if after doing that calculation the qualifying R&D expenditure represents 40% or more, you qualify for this high intensity threshold. And what it means in a nutshell is it's not entirely good news in the fact that, as you saw in the previous slide, the enhancement rate decrease on the SME scheme, so 130 down to 86%, and the additional reduction from 230 to 186. That will still be in place. The only difference is the company will be able to keep its original surrender rate at 14.5%. So instead of only being able to surrender at 10%, it can surrender at 14.5%. So in a nutshell, that was sort of what was brought in to help ease the burden. It's a little bit of something, some people might argue, is that enough for some companies? But that was what was sort of brought in at the time. The threshold itself was updated, and we'll touch upon this in the autumn statement as well. That threshold has been adjusted, which we'll delve into a bit more detail on, but that's the high intensity threshold. The key point finally to mention about this threshold is although it got announced in the spring 23 budget, it can only be effective once the Finance Bill 23-24 comes into effect. And right now, I believe it's about to undergo its second reading. So as of right now, the bill hasn't formally come in. So that's something to keep in mind, is whilst it was announced, the threshold's in place, it hasn't actually been passed just yet. So as of right now, companies who are claiming and it could affect them, they can't actually utilize it, albeit when it does come back into play, if you're a company that has submitted a claim, you can look back and see whether to amend your claim if you do qualify for that threshold, or you can potentially hold off submitting a claim until this threshold does actually become live.
Thanks, Pieres. So the additional information form, this is quite, it's a compliance requirement that has been brought in by the government. And I think this was in response to all of the issues with fraudulent R&D claims and inquiries, which we will touch upon later in this session. The additional information form, what is it? Well, it's a form that must be submitted prior to making any R&D claim on the corporation tax return. So a form has to be completed and submitted by the company or the agents to give information about the R&D claim. I mean, you could look at it as a replacement of what those of you would know would be the R&D technical report. That is a common compliance. It wasn't a legal requirement, but it was best practice to always submit an R&D report with the tax return to evidence why the company qualifies for R&D, and also on what level of expenditure and how the qualifying expenditure for R&D has been claimed. So this additional information form is live. It's got to be submitted. It must be submitted prior to the submission of the tax return. It replaces the traditional R&D report, although I don't see any harm in submitting. You could also submit the R&D report alongside with the tax return if you wish to, but the key point is the additional information form must be submitted. What's in the form? Well, many of the requested details probably remain similar to what you would include in the R&D report. So, for example, you will be outlining the projects that you're claiming for. You'll be outlining the advance. What's the advance or improvement? What are the technological or scientific uncertainties? What work is being undertaken to resolve the uncertainties? And you'd also be looking at if there's any knowledge or processes that are already out in the public domain. You're doing your benchmarking analysis of showing why this project isn't readily deducible by a competent professional within the industry. So many of the details remain similar to the technical report that would be submitted. There's a couple of bits of new information that's now required. Those bits I've listed there are, so companies are required to include details of their PAYE reference, also their VAT reference, VAT registration number, that should read. And the form requires details of the senior person at the company that's responsible for the claim. So it's very much passing onus on the company, to take responsibility. Who's going to take responsibility for the submission of that report? As I said, it must be submitted before the R&D figures are. I think there was some statistics sent by the revenue or released by the revenue that said something like almost half of R&D submissions between a period last year did not have the form submitted. What happens if the tax return is submitted without the additional information form being submitted prior to the tax return is that the revenue will simply reject the claim. The claim will be deemed, the R&D claim that is, the R&D claim will be deemed to be invalid, and the company will get a letter saying the R&D claim is invalid and asking the company to submit the additional information form. So their HMRC will send out letters in that respect. So it's really, really important that the form is completed, and it will invalidate the claim if the form isn't completed. And the problem with that is that if the company is nearing the end of the deadline to be able to submit the claim, you don't want the company to be out of time to submit the claim because the additional information form hasn't been submitted. So it's really, really crucial that that is done. So just moving on.
Perfect. And now we arrive at the little bit of good news that was announced at the time after all the rate changes and the compliance changes, is the concept of extending the qualifying criteria. As mentioned from the start, the two areas that had their definitions amended or extended was pure mathematics and data and cloud computing costs. Those were the two areas that were looked at. To delve into a little bit more detail on these regarding, pure mathematics to begin with, there was a part in the BIS guidelines at the time, or the guidance at the time, that stipulated that pure mathematics wasn't allowable for R&D purposes. And what that in a nutshell meant is it was one of the areas of the guidance that wasn't really explored. It was very vague on what it meant by pure mathematics. And the only definition it had is something that didn't have a tangible effect in the material universe or something like that off the top of my head. And for the longest time, it was never really considered. There was never really much of an issue with it until probably about a couple of years ago, where what HMRC started to do was started to pick up on this concept of pure mathematics. And when software and technology claims were going through investigation, but also engineering-based ones as well, a little bit less common, but primarily software, is what they were trying to argue is some of the advances that some of the companies were trying to achieve weren't actually advances in software or engineering, but were instead advances in this concept of pure mathematics, because a lot of the advances weren't having a tangible impact in the material universe, obviously software primarily being intangible in nature. And because of that, we were seeing some pushback from HMRC, pushing back on claims, and you're looking to reject them or disqualify certain costs, etc., etc. That has now been cleared up. This concept of pure mathematics is now fully being integrated and is allowable. But the key point, similar to both of these points we're going to touch upon, is it's for accounting period starting on or after April 23. So keep that in mind if you've got an accounting period that hasn't reached that point just yet. The second concept, which I know was heavily, warmly received by software and technology based companies in particular, was data and cloud computing costs. So again, software costs, the original guidance around qualifying software items was reasonably quite vague in the original guidance, which technically is still active until this guidance supersedes it. And again, we almost end up in a position where people had a difference of opinion with HMRC regarding some software costs. HMRC were trying to argue, in particular, the purchase of data sets and cloud computing costs didn't actually qualify as a software cost, and nor did it qualify as a consumable cost. And as such, we're looking to disqualify these claims. Anyone who operates in any of these industries, particularly software, knows how expensive, cloud computing based costs and the purchase of data sets can be. It can usually runs into tens of thousands of pounds. So there was a bit of interpretation difference there. And so again, one of the changes that was announced is this concept of data and cloud computing costs will now become allowable, and it sort of clears that up. One of the key things to keep in mind with regards to data and cloud computing costs, though, because the same with everything, there is nuance to it, which is although this guidance does allow it, it only allows direct costs related to the R&D activities itself. So just to give you an example, if a company purchases a data set, it can only be used for the R&D activities. The company can't resell it, and also that data set can't have a use outside of the R&D activities. So this is where we're getting into this concept of it, direct relation to the R&D project or R&D activities. And it's the same for the cloud computing costs as well. So anything regarding remote data storage, etc., it's all got to be things that are directly related to the R&D project, and not for like viability research and things like that. Something that's more indirect in nature. So that's something just to keep in mind moving forward, with the biggest caveat that this is obviously for accounting period starting on or after April 23, very specific in that. So that's something to keep an eye out. But overall, good news here regarding expanding the definitions.
Thanks, Piers. So unfortunately, back to slightly more bad news again. So the claim notification form, I think this, just to be clear on this, because I think there's been some confusion around this and the additional information form. So just to be clear, these are two entirely separate compliance requirements. So we've got the additional information form that I touched upon before, which is required to be submitted prior to a company making a claim. The claim notification form is appropriate for companies that are claiming for the first time, or the last claim that was made was more than 3 years before the last date of the claim notification period. So most companies that have a legacy of claiming R&D tax credits that are already claiming that are in the system will not have to be concerned by this claim notification form. However, so it's really for new entrants to the scheme to be thinking about. So to be clear, it affects accounting periods starting on or after April 23. It's a form that must be sent to HMRC to inform them of an upcoming R&D claim. So again, it's got to go in before any additional information form that is required, before the tax return containing the R&D claim. The form details are actually similar, unfortunately, to the additional information form, but it's more of a high-level summary. So basically what it is, it's an abbreviated additional information form. As with everything, you know, with normal time limits, there are time limits for this claim notification form as well. And the time limit to inform the HMRC of an upcoming R&D claim is 6 months from the year end. So that's quite a short window. And obviously, if the claim notification form isn't done, or isn't done in the right time, then it could preclude a company from claiming R&D, which could be disastrous. So it's really important to be aware of this claim notification procedure. Obviously, the time limit is adjusted for shortened or extended accounting periods. I've got an example here. So a company with an accounting period of March 26, it's got 6 months from the end of the accounting period to notify the revenue. So it's got to, HMRC, so it's got to notify, the company should notify HMRC that it intends to make a claim via submission of the claim notification form by the 30th of September 2026. So that's just really, really important for those new entrants in the scheme to be aware of this claim notification form. It's separate to the additional information form. And again, it is a compliance requirement that must be satisfied for companies that haven't previously claimed. Just coming on to the next slide.
Yeah, and I think this might be the last thing we touch on regarding the spring budget. But yeah, what was also announced at the time, and there has been some changes as to the effective date. But yeah, originally we had this concept of relief towards the UK, and this was all about the government ultimately becoming concerned that the generous R&D tax relief scheme that we had here, the benefit was potentially leaking outside of the UK too. So to sort of address that, they said, okay, let's step in and look at ways that we can try and maintain and keep the benefit arising from this tax credit here within the UK. So in a nutshell, what we basically had was the change that non-UK subcontractors and externally provided workers basically won't be allowable for R&D claims moving forward. I don't believe that we're very original in a restriction like this, as I know working with other companies who have claimed, I believe under the US and Australian base schemes, I believe they've got very similar rules in place. So I believe it's more sort of following a trend of other similar schemes elsewhere. And yeah, so it's quite a big change, and obviously heavily impacts any companies that are heavily investing in subcontractors and external providers that are abroad. So the key thing to keep in mind for this is what we have been explicitly told already is, like everything, there are exemptions to the rule, where non-UK subcontractors and EPWs can be allowable. However, the exemptions are very restrictive on what will be allowable. So in a nutshell, what we're talking about in terms of exemptions, very high level, are things like, you couldn't undertake your R&D activity here in the UK for things like geographical issues. And I know that one of the examples that was given in the guidance was deep sea research, where here in the UK we just don't have the environment or the climate or whatever it may be to undertake a specific activity. Therefore, the company was left no option but to take this abroad and incur costs abroad on subcontractors, etc., etc. So that was just one of the examples that was given. We also got whether there's any legislative issues here in the UK that prevent certain activities, but they can be done elsewhere. Maybe some type of forms of clinical trials and all of that sort of thing. So again, quite restrictive. It's basically you've got to be in a position where you literally cannot conduct your R&D here in the UK and you're left no option but to go abroad. What we have been told is, the reason for taking your R&D abroad due to financial reasons, i.e. it's more cost efficient to take it abroad or outside the UK. That's already been deemed, not a good enough reason and will not meet the exemption. So obviously it's a big blow for companies that do a hell of a lot of subcontracting outside of the UK. So it's early doors, probably becoming aware of this and looking at steps, to sort of plan for this. And there are a few things that companies can do. And just to be clear on this is, it was originally scheduled to come in, accounting period starting April 23, but has been postponed to accounting period starting April 24. So to navigate around it, early doors companies, hopefully companies are becoming aware of this early enough where they can sit there and go, is there a way that we can bring our R&D activities back to the UK? that's, if I'm being honest, sort of the intent of this change is to get companies to sit there and go, look, we're doing our R&D rule. Can we bring it back either in-house, which would probably be ideal for the R&D scheme if we're able to conduct it in-house internally, or at the very least, can you start utilizing UK contractors instead? That's sort of, the workaround there is to start, consolidating and bringing everything back internally. Or the other thing, is just so you can prepare, and sort of a lot of companies that do forecasting, as long as they're aware moving forward that their R&D claim might take a substantial drop due to some of these costs no longer being allowable, then I think, and get themselves primed up, in a position where, okay, we're not going to expect to receive X amount anymore, and adjusting, things accordingly. So again, a bit of bad news, but unfortunately, in regards to other schemes out there, it's sort of following the trend, if you like.
Thanks, Pieres. So that brings us to the end of the spring budget changes. So a lot to take in there. And as if there wasn't already a lot to take in, then we come to the autumn budget, where there's even more changes, unfortunately. Autumn budget brought further changes to the R&D scheme. Again, there's been further significant announcements by the government in the autumn budget with regards to R&D. Not unexpected, personally. With the rate changes happening as they did, it wasn't unsurprising to a lot of us that they announced this concept of a merged scheme. I think there was there's been some rumblings of this for a while, so it hasn't surprised us that this has now been announced. So just to be clear, these changes impact accounting periods starting on or after April 24. It's very soon. To be, after all the changes that have already been implemented, it's very soon to be starting to implement yet again some more changes. And I know that there was a lot of representations made by various accountancy firms and professional bodies about the concern with regards to these changes and the changes being brought in so soon. Unfortunately, it didn't seem to sway anything. So these changes are due to go ahead, as I said, for our accounting periods on and after April 2024. It is concerning because it doesn't give a lot of time for everybody to get up to speed with these changes. The last time the revenue brought in substantial change to the tax return itself for those that you will remember, was the introduction of this new supplementary page CT600L. And there were significant issues that agents experienced with the submission of the form. And I think the revenue software wasn't quite geared up for it. So it was all quite challenging at the time. And unfortunately, here we are again, and more changes that have been brought in quite quickly. So the key changes, what are the key changes that were announced at the autumn budget? So we've got the main one being the announcement of the merged scheme. We also touched upon in a previous slide about this concept of the high intensity threshold. So, that hasn't properly been legislated for, as Pieres has said, but even despite the fact that it hasn't been formally legislated for, we've got more changes to this concept of the high intensity threshold that we will go into more detail in a later slide. One of the smaller changes that might have gone unnoticed by some is this is with regards to repayments to nominees. So we will go into a bit more detail about those changes now.
Yeah, so to kick off on the largest change that was announced is obviously now the merged scheme coming in. And if I'm being honest, the name pretty much says what it is, where effectively what they have done is from accounting period starting on or after April 24, they've effectively taken the traditional, what was the SME scheme, and the RDEC scheme, and have basically merged them together. And what we mean by that is that they've taken elements of both schemes to basically consolidate everything into ideally one scheme. Obviously, originally when this was all first pitched, we thought it was going to be, nice, easy and straightforward. But obviously with this now, the introduction of this high intensity element, things aren't necessarily as straightforward. I know a lot of people may have heard of it, just thinks, moving forward is going to be one R&D scheme. And it's a bit like, yes, maybe technically yes, but we've still got to factor in this notion of the SME high intensity threshold as well for the companies that qualify under that. But by default, it looks to be like, unless you meet the high intensity threshold that we'll touch upon, companies will just by default fall under the merge scheme moving forward. What we'll do over the course of the next few slides is we'll look at the merge scheme, talk about some of the key areas where they've taken guidance from each of the schemes, and we'll talk about, you know, what the rules were under the old schemes and what rule has been adopted for the merge scheme. And as you'll probably see throughout as we go through, you know, as you can imagine, the areas that have been adopted by the SME scheme are obviously favourable, and some of the areas that might have been adopted by us that might be less favourable potentially. But, you know, we'll discuss all of that in more detail in the next couple of slides.
Okay, so delving into the more detail. So merge schemes. So under the two existing schemes that we have at the minute, subcontracting costs are generally allowable under the SME scheme. Obviously, it's where a company subcontracts out to a third party, it's R&D. So they're generally allowable. There is this restriction of 65% for unconnected subcontractor costs. That's subcontractors that are unconnected parties. The restriction may be lifted in certain circumstances, either where you have a subcontractor that is connected to the claimant company, or on occasion it's possible to get a joint for both parties. So that's the claimant company and the subcontractor to enter into this election, which enables the claimant company to basically potentially claim more of the cost. So you're relieving some of that restriction. So subcontractor costs under the SME scheme generally allowable. RDEX scheme is the opposite. So currently subcontractor costs are not allowable under the RDEX scheme. I would caveat, there are some exceptions to that rule. And where you have subcontractors that are qualifying bodies, individuals or partnerships, then it is possible to be able to claim those subcontractor costs. However, the RDEX scheme is more restrictive with regards to being able to claim subcontractor costs. Luckily, in terms of the merge scheme, the good news is that the merge scheme has adopted the SME rules. So therefore, it's adopted the more favourable option for taxpayers, which is really good news. I would caveat that is still subject to the overseas restrictions that Pieres mentioned in an earlier slide. So just be aware that whilst it will be possible to claim subcontractor costs under the new merge scheme, it still comes with these restrictions, these overseas restrictions that were announced in the 2023 spring budget.
Cheers for that. So yeah, moving on. So the next area that was heavily looked at when the merge scheme has been formed is what some people might be familiar with is subsidised expenditure. So this is where a company receives some form of state aid, notified, unnotified, or some form of grant. And what is quite common in the R&D space, obviously if there's any companies on here, you might even be aware of it yourself, where it's quite common that if you're innovating and doing something interesting, cutting edge, whatever that might be, it might be common for companies to also go out and get a grant or some form of state aid to supplement their expenditure as they continue their development activities. And also what is quite common for companies to do is not only get some form of state aid or grant, it's also common for them to claim R&D tax credits as well. And this is what causes a bit of a conflict. Traditionally under the SME scheme, it's always been deemed a notified state aid. The SME scheme is as well, and under tax rules and tax legislation, there becomes complexities when a company tries to claim multiple notified state aid. So what used to happen under the SME scheme, there might have become some companies that have experienced this, where by default they used to fall under the SME scheme, but they received some form of notified state aid for a particular project, or a grant for a particular project. Grants are usually very project specific. I know Innovate UK is quite a big one that a lot of companies go to for grants or some form of subsidy to support R&D activities. And what companies were traditionally find themselves as in a scenario of is if a particular project received some form of grant funding, then that project could no longer qualify under the SME scheme, albeit it could qualify under the RDEX scheme. So you're having situations, or used to, or still do technically have situations where companies might have a bulk or a portion of their claim go into the SME scheme because that's the scheme that they naturally qualify under. But then when they start receiving, notified state aid or grant income, all of a sudden, some of that project actually needs to go into the RDEX scheme. So they're actually claiming under both schemes at once, which can be, as you can imagine, quite cumbersome and complex depending on the records available of being able to split that expenditure up. There was also further complexities regarding notified versus unnotified state aid in particular, where notified state aid, which was pretty much if one project received even £1 of notified state aid, then the entire project must go under RDEC. All of the expenditure related to that project that qualifies for R&D must go under RDEC. In contrast, when you're talking about unnotified state aid or some form of subsidy, general subsidy, then it would only be the amount up to the grant or subsidy that had to go into the RDEC scheme, with any excess still qualifying under the SME scheme. I appreciate, quite complex, and obviously that's before even discussing, de minimis rules and stuff like that, and exemptions and all of that sort of thing. Under the RDEC scheme, it was way more straightforward, where the RDEC scheme was never considered a notified state aid, so you never had those restrictions in having to apportion out, any grants or anything like that. Where we sit with the merge scheme is fortunately the merge scheme has adopted the traditional RDEX scheme rules, which is one of the probably few areas which the RDEX scheme had something maybe slightly more favourable than the SME scheme, which was, there is going to be no reduction of relief, if you have received, notified state aid grants, subsidies, that sort of thing of that nature, which is, quite positive.
Thank you, Pieres. So more detail around the merge scheme. So the PAYE cap. So currently at the minute, the PAYE cap features in both the SME scheme and the RDEX scheme. The complexities around that are that under the SME scheme, you've got one calculation, and under the RDEX scheme, you've got a slightly different calculation. So basically what the PAYE cap does is it comes along and it restricts the claimant's ability to be able to reclaim an R&D tax credit. So it's where you're surrendering losses. Under the SME scheme, it's where a company is surrendering losses for a repayable tax credit. There is this restriction in terms of the PAYE cap. And the current restriction limits the amount of payable tax credit to the sum of £20,000 plus 300% of the company's total PAYE and NIC contributions for that period. So the RDEX scheme is a slightly different definition. And that, again, there's a restriction on the amount of the RDEC credit that can be obtained in terms of a cash repayment. And the restriction is actually based on the R&D workers' PAYE and NIC. So it's less generous in terms of the amount that can be claimed back. So the merge scheme is, the good news is that the merge scheme adopts the SME scheme PAYE cap, so it's much more beneficial to taxpayers. Just a caveat on the SME scheme. So whilst there is this concept of this PAYE cap as it stands at the minute, the £20,000 plus the 300%, there is an exception to this PAYE cap under the SME scheme. And that exception is that the company is exempt from the cap if its employees are creating, preparing, or managing intellectual property. And there's also a second qualifying condition, and that is that the company does not spend more than 15% of its qualifying R&D on subcontracting R&D or the provision of externally provided workers. So generally speaking, the cap applies unless the company falls within the this exemption. So yeah, so just to re-emphasize, the merge scheme is again a bit of a good news. It's adopting the more favourable PAYE cap, so that's a bit of positive news.
So outside of the rule changes that we sort of covered, where some of the guidance has been taken from the SME and RDEC, obviously what we'd like to touch on now is the mechanics of the merge scheme, because as anyone who might be aware or has claimed before or claimed under both schemes, you know, once you've got your qualifying expenditure for the SME and RDET scheme, the method of which you get relief, the mechanics behind it is actually quite different. As you know, we touched upon the rate changes earlier on. The SME scheme, once you've got your qualifying expenditure, you know, depending on where you are, whether you're profit making or loss making, obviously you've got your various enhancement rates that can apply to then, you know, lower your profits or create a loss or increase a loss. And then with those losses, as anyone who will be familiar with the SME scheme, you're able then to surrender that for a cash credit, either at 14.5% or the new rate at 10%. That was announced. So it was the SME scheme was always a method of giving relief, always a reduction in chargeable profits, and you got various enhancement rates and pieces for that, which made it a very lucrative scheme, particularly before the April 23 rate changes. The RDET scheme behaved very differently, where it wasn't so much a way of reducing taxable profits, but what it was a direct method of giving a company a line of credit, a taxable above the line of credit. And what we mean by that, you know, the way it behaves is there is no enhancement rates under the RDET scheme. So once you get your qualifying expenditure, there is no enhancement rates. There's nothing like that whatsoever. It simply looks at it and goes, here's your qualifying expenditure. We're going to give you above the line tax credit of, as we know now from the changes, of 20%. And obviously because it's taxable as well, obviously you need to factor that in as well, you know, it being subject to tax. The nice thing about it, if there is a nice thing to say about it, is the rate under the RDET scheme was always the main rate of tax, which obviously anyone who's aware of, from April 23, the main rate of tax did increase from 19 to 25%. So that was something else, you know, in terms of a bit of a drawback to the RDET scheme when that happened. In terms of where the MERS scheme sits, as you can see there on the slide, the MERS scheme has unfortunately adopted the RDEX, you know, mechanics, if you want to call it that. The slight difference between it is, you know, whilst you don't get any enhancement rates, you don't get anything like that per se. The slight caveat here is with the MERS scheme, instead of it being taxed at, you know, the main rate of tax, which has increased to 25%, it has been set at 19%, which was the tax rate pre the recent changes to the corporation tax rate. So if you wanted a touch of good news there, you know, it has been confirmed, it has been set at 19%, but overall, you're not going to experience, you know, the enhancement rates or anything like that most people have come to know about the SME scheme. So it's slightly unfortunate, but that's sort of how it will behave, the MERS scheme, once it comes into play.
Thank you. So going back to the SME intensive scheme, so I think when the merge, as Pieres touched upon it, when the merge scheme was announced, I think everybody thought, oh, great, simplified, one merge scheme. But actually, we've still got this concept of this SME intensive scheme. So some would argue that actually, you know, it hasn't simplified the scheme. There's still these complexities around this this intensive scheme. So just to be clear, the SME intensive scheme will run alongside the new merge scheme, and it will benefit those who can qualify under it. So it's more lucrative than when compared to the new merge scheme. Again, you've got this qualifying criteria. So I see it really as a two-stage process. So firstly, does the company qualify under the SME scheme? Secondly, does it satisfy a threshold? Now, I think we said in the spring 2023 budget, the high intensive scheme had this threshold, this concept of this 40% of the total qualifying expenditure has to be at least 40, R&D has to be at least 40% of that. Unfortunately, the bad news is that 40% has now reduced to 30%. So that's a bit of a shame. But basically, the goal of the scheme, as we touched upon it before, is to reward companies who spend a large proportion of their expenditure on R&D. Now, there is, in the finer detail, there is a 1-year grace period, and that will allow companies who fail to meet the intensity threshold, because, for example, there's been a one-off shock, I don't know, such as exceptional items of expenditure or fluctuations in expenditure. So what it will allow a company to do is it will allow them to continue claiming the enhanced support in that year if it meets the intensity threshold and successfully claimed enhanced support in the previous year. So This 1 year grace period will apply for accounting periods beginning on or after April 2024. So just moving on.
And finally, yeah, just because we know it's been a sort of long-winded discussion going through the various changes, we just thought we'll give you a bit of a side-by-side comparison of what the merge scheme and the SME intensive scheme looks like and its behaviour. So as touched upon before, with the merge scheme, above the line credit of 20%, no restriction on subsidised funding. The PAYE cap adopts the SME criteria, and also the notional tax rate, or the tax rate that's applicable to the scheme, is set at 19% rather than the main rate of tax. And obviously the SME intensive threshold there on your right hand side, you know, this obviously basically follows the old SME scheme post April 23. That is obviously caveats, obviously that's when the rates came down. And obviously you've got the concept of, as Kate just mentioned, the 30% on total expenditure. And obviously the enhancement rates, obviously, as we know, that got reduced from 86%. Obviously, if you qualify under the SME intensive scheme, the surrender rate is 14.5% as opposed to 10%. And at the bottom lines there across both of the tables, what we've got is just to give, you know, companies a bit of an idea, because I know when companies are sitting there going, okay, there's a lot of intricacies here, but roughly what can I think of in my head as a sort of benefit that I could get back? So I just thought I'll cover this again really quickly, because I know the SME and RDEX scheme rates were sort of mentioned at the start. So just to sort of recapture that, prior to April 23, the SME scheme used to provide a benefit up to about 33%. After the post-April 23 rate decreases came in, as Kate mentioned, it fell to about 18.6%. For the RDEX scheme, pre-April 23, it was about 10.5%. And then post-April 23, assuming obviously all the expenditure qualifies under the new and old rates, it then increased to 15%, because obviously RDEX rates went up. So with the merge scheme, what you're looking at here is about 16.2%. So in a nutshell, you know, for every £100 I spend, I'll get about £16 back in relief. That's the way to think about it. And the SME intensive scheme is about, you know, just shy of 27% as a maximum. So in a nutshell, if you wanted to do your comparison there, the merge scheme, you know, if you think about the concept of it taking areas of the SME and the RDEX scheme, you know, post April 23, you know, as we mentioned, the RDEX scheme was giving you a benefit of about 15%. The SME was giving you a benefit of about 18.6%. So as you can see, by taking areas of both, the merge scheme sits in the middle of the SME and the RDEX scheme, which was what we was always anticipating. And then with the SME intensive scheme, as we mentioned, the pre April 23 benefit under the SME scheme was about, you know, 33%, post about 18.6%. So again, this SME intensive scheme, because you've got the reduction in enhancement rates, but you keep your heightened surrender rate at 14.5%, once again, it sits in the middle. So what we're looking at as an overview with these changes is, you know, certainly the SME and RDEX scheme have become less lucrative post April 23. And then with the introduction of this merge scheme with the intensive scheme, once again, it looks like, you know, that's where the benefit is going to sit. So another slight reduction. Hopefully, you know, fingers crossed, because it has been a lot of changes, we sort of, you know, plateau here and there's not too many more aggressive changes, because as we're discussing now, there's been so many changes in such a short space of time. But high level, that's how things look.
Right. Thank you, Pieres. So just coming on to just a final point on all of these changes, and it might be one that's been overlooked. I mentioned it at the very start, but it might have a significant, you know, it's likely to have a significant impact for some agents. So with effect from April 24, it's not going to be it's no longer going to be possible for repayments to be payable to nominees. So you will not be able to receive any, a nominee will not be able to receive any R&D repayment on behalf of a client. And then also another point to mention is that there's not going to be allowed any new assignments of R&D tax credits, and that change has already taken place. So just a small point to note, but it might be an important point for those that do actually receive repayments as a nominee for that company. So that brings to end the spring and autumn budgets. A lot of changes to take in. We did thought if we had enough time that we would touch a little bit upon inquiries and the current climate. So we'll keep it. I'm just conscious of time, so we'll keep it quite succinct. But we thought it was just an important point to address. As I mentioned, we did discuss this in a bit more detail in the last webinar. So if you'd like those slides, let us know. But we'll just touch a little bit upon the revenue and their approach to inquiries at the minute. So there has been a significant increase in the revenue launching inquiries into R&D claims. That was as a consequence of some fraudulent claims being put in. I think it was probably last year or even the year before now, and the revenue stepped up their level of inquiries quite significantly. Now, the way that those inquiries have been approached has been problematic for agents, for companies within the industry, and those submitting R&D claims. And it came to a point where there were so many problems that the Chartered Institute of Tax have got involved, and there has been some communications between the HMRC and the Chartered Institute of Tax, which started in, I believe, July 2023. So there's been a bit of backwards and forwards about the way that the revenue have handled and are handling inquiries, their approach to inquiries. That communication is quite a good read. If you'd like to have a look at that, let us know and we can send the links. It's on the Chartered Institute of Tax website. And the first letter that the revenue actually sent to the Chartered Institute of Tax sent to the revenue basically cited examples of poor behaviour in Pieres. I think it's fair to say we've probably seen, in our handling of inquiries, we've probably seen all of those examples of bad behaviour, bad behaviour. So things like typographical errors, problems with incorrect client names, incorrect accounting periods. This has probably come as a result of the revenue's approach to inquiries, and their approach has very much been this I've put on the slide. It's a bulk compliance approach. So whereas you would typically have a caseworker that's assigned to an inquiry, what's happening is there's a group of caseworkers within the revenue that are looking at these inquiries between them. And so what that means is there's unlikely to be consistency between the handling of an inquiry, and it could actually go through various caseworkers at the revenue, which is causing a lot of issues for the industry as a whole. The other unfortunate point that's come from all of this is it seems to be the default approach by the revenue is that the behaviour by the taxpayer is careless, and therefore a penalty applies, and we are tending to find that is the becoming the norm for these inquiries. It's quite common for the revenue to start talking about penalties and carelessness. So the legislation, the point to make is that legislation hasn't changed. Ignoring all of these budget changes, obviously these inquiries have been on. Some of them have been open, sort of a couple of. We have taxpayers that have had open inquiries.
What hasn't changed is the activities that qualify for R&D have changed. The whole point demonstrating that an advance has occurred, the technological or scientific challenges, all of that criteria for projects that qualify has remained the same. But as Kate's mentioned, we're finding that HMRC's interpretation has become quite narrow, quite aggressive, very combative, if we're being probably completely honest. So it has been a bit of an experience. Obviously, it's become so much of a thing that I know that we've got involved supporting third parties with their investigations they've had open. It's become a bit of a service that we offer is R&D investigation work, and and because of that we've got involved in so many different types of claims. Size doesn't seem to be a matter either. I know historically people have always thought, but my claim isn't that large. Unfortunately, that doesn't seem to matter. Obviously, some of the most common inquiries that we've seen in terms of industries have been software and sort of like food and drink manufacturing in particular, which I can say I probably spend a little bit less time on. My focus I tend to spend in software and technology. And I think at this point, I've heard every standardized argument that HMRC take as an approach to that. And, you know, it's usually them attempting to say that the advance that the companies try to achieve is just commercial, or it's just for the business only. It doesn't push the boundaries of the industry as a whole. So that will be one of the things I'd always say, you know, if you are putting together a claim, is keep these things in mind. You've always got to revert it back to your industry as a whole and looking at how you're pushing the boundaries and limitations of your industry as a whole, and not just what might be unique to yourselves or unique to your business, or improving your knowledge so it meets the standard of the rest of your industry. You know, if something new comes into your industry and you're just getting yourself up to speed, that might not always necessarily qualify. Obviously, R&D is great and there's always nuance, but these are some of the most common things that we are experiencing. And as we're saying, you know, inquiries can also last, you know, 9 months to 12 months as well on average, so they're quite a lengthy process to experience as well. Sorry.
And just a final point to note, I do think the tide's turning. I think the revenue have taken on too much. We are certainly we've won actually 2 R&D cases on appeal this week, so you know there has been we've seen a slight shift. So that's the good news. I think they've taken on more than they can handle, and they're not able to deal with the volume of inquiries that they've opened. So there is some good news. I think you know, it's quite scary getting an inquiry, but with the right support, you know, it is possible to win inquiries, and we are winning on inquiries, aren't we, Piers? So that's the good news. I'm just conscious of time. I've overrun a bit, so I think that brings to end our webinar this morning. So thanks very much for all of you that have attended. A lot to take in. We're quite happy to send. We will send any the recording and the webinar notes after. And just a quick note on some upcoming webinars. So we've got the spring budget, which is being presented on Wednesday in March, 13th of March. Tim's back doing a capital allowance webinar on the 21st of March. And we've got also an inheritance tax update and planning given by Michaela on the 11th of April. And yes, if you could take a few moments to complete our feedback survey, that would be really good. Thank you very much, everybody. And well, I've just put on, those are myself and Piers's details. If you've got any queries or things to ask us, please do feel free to contact us. Those are our email addresses. Thank you, everybody.